Welcome back to the Daily Crypto Roundup. Today we've got a packed show because the news cycle has properly kicked back into gear, and some of what's coming out today could shape how next week opens for the entire market. We're talking about a new executive order to classify digital assets into clearer categories. We're going to discuss where wealthy and institutional investors are reportedly increasing their crypto exposure even after the recent pullbacks. Kraken's CEO has gone on the attack again, warning that UK regulation is pushing innovation away. Spain's Santander is expanding its open bank digital services in Europe, and that has a few interesting implications for how traditional banks are starting to fold crypto rails into mainstream banking. And finally, we'll get into one of the big market tension stories. Analysts disagreeing sharply on whether next week is going to continue this mini bounce, or whether we're going to see another dip before month end. So we'll look at both sides and give a proper balanced take instead of just picking one narrative. Before we get into all of that, if you're listening on Spotify or Apple, do us a favor. Make sure you follow the show and leave a 5-star rating. It really helps push the podcast out to more people, and it means you'll always get the episode the moment it drops. Right, let's get into the market. Bitcoin begins today at around $101,585. That's just a little softer across the 24-hour chart, nothing dramatic, but it's holding above that psychological 100,000 line, which has been acting like a trampoline all week. Ethereum is sitting at around $3,417, down a touch but stabilizing after last night's volatility. BNB comes in at $950, still holding its recent breakout range even after that 7-day rally. Solana trades at $153, which is actually not too far from where it's been consolidating lately. A bit choppy, but still very strong compared to the wider altcoin market. XRP is around $2.34 and has been one of the quieter majors today, moving in a fairly tight band. Cardano sits at 54 cents, Dogecoin is at 17 cents, Avalanche is around $16, Tron is roughly 29 cents, and Polkadot sits around $2.93 after a mild lift over the past few sessions. Nothing particularly explosive in the majors, but the theme today really is stabilization. The market is cooling off after that sharp early week bounce. The first big story today is coming out of Washington, where the SEC has confirmed it's now moving forward with the groundwork for a proper token classification framework. This isn't a case of a president signing a new executive order today. It's the SEC acting under the broader pro-innovation direction set earlier this year when the current administration created a digital asset working group. What matters is that regulators are finally signaling they want clear rules on what counts as a payment token, what counts as a utility asset, and what falls under investment contract rules, and analysts are already reacting to it. One institutional note this morning said, "If the US lands on a proper classification system, crypto can finally grow within a stable regulatory environment." It's early days, but the message is simple. Clarity is coming, and markets tend to move long before the rules are officially in place. We already saw earlier this year how quickly institutions moved when the Bitcoin ETF gained predictable guidelines. If this order really does settle long-running arguments about token categories, analysts are saying we could see a wave of new products. Tokenized income assets, tokenized treasuries, regulated stable yield products, and yes, the report even floated the idea of regulated staking-like structures for institutions. Whether that gets passed is another question, but it shows the direction of travel. And one analyst from Bernstein said today, "If the US lands on proper token classifications, the floodgates open. This entire market re-rates upward." That's a very strong line, and it feeds nicely into the second story of the day. Before we go into the remaining stories, we're going to take a really quick break. Don't go anywhere, literally 30 seconds, and we'll be back with the rest of today's top news.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
Let's get into the next story, because story 2 is all about investor behavior, and this one genuinely surprised a few people. MarketWatch published a new survey this morning, showing that 61% of high-net-worth investors and professional asset managers plan to increase their crypto exposure over the next 12 months. This is despite the volatility, despite the shakeouts, despite the regulatory mess earlier in the year. The takeaway is simple. The people with the biggest portfolios and the widest access to information are not stepping out of the market. They're stepping in. Now, what's interesting is why. The survey points to 3 reasons. First, they see Bitcoin as a form of digital hard money, especially with global debt concerns rising. Second, they believe the crypto market is entering a multi-year phase of institutional integration, tokenization of assets, the rise of yield-bearing instruments once classifications are defined, and traditional banks offering on-chain services. And third, they expect clearer regulation, not harsher regulation. So the first story and this second story work hand in hand. Regulation shifts sentiment, and sentiment determines inflows. But we don't want to paint a one-sided picture. Analysts like to sound bullish when conditions look good, but there's a realism creeping into some corners of the market. Take what Deutsche Digital Assets said this morning. Institutional interest is rising, but volatility will remain a feature of crypto markets as long as macro uncertainty remains high. That basically means, yes, institutions want more crypto, but they'll stomach turbulence as long as the long-term picture is attractive. And for many of them, it is. Which brings us to story 3, and here's where we move from the US to the UK. Kraken CEO Dave Ripley came out swinging today, criticizing the UK's regulatory regime again. According to the Financial Times, he said the government's rules are deeply unclear, overly restrictive, and making it extremely difficult for the industry to innovate. This isn't the first time Kraken has sounded the alarm, but the timing is interesting. Kraken is actively expanding in Europe, it's preparing for changes in the US, and yet in the UK, the mood is turning sour. For our listeners in Britain, this is worth paying attention to because Ripley said something very pointed. The rules are not aligned with global standards, and the UK risks isolating itself from the next phase of financial evolution. Now, to be balanced, the UK's Financial Conduct Authority claims the rules are meant to protect retail investors and prevent aggressive marketing tactics. But the wider industry's frustration is growing. If the US offers clarity, Europe rolls ahead with MiCA, and the UK stays in this halfway house of not banning anything but not enabling anything, the UK could genuinely lose ground. And it's not the first tech sector where that's happened. Analysts at Pantera Capital said today, the UK's biggest long-term risk is becoming a spectator while others build the infrastructure of tomorrow. That's strong language, and it ties perfectly into the next story. Because story 4 takes us to Spain. And Spain might quietly be one of the most interesting parts of Europe for digital banking right now. Santander, one of the biggest banks in Europe, is expanding its open bank service across more European countries. And behind the scenes, they're preparing to integrate more crypto-related services. It's subtle. They're not doing the US thing of holding Bitcoin directly on the balance sheet. But Openbank is now investing heavily in tokenization systems, custody rails, and internal blockchain settlement tools. They've even partnered with tech firms specializing in digital asset accounting. Reuters ran a piece this morning saying the expansion signals broader European banking interest in blockchain-powered settlement. Now, none of this is explosive in a headline sense, but this is exactly the type of infrastructure shift we talk about all the time on this show. It's not the meme coins or the hype spikes that build long-term value. It's the quiet structural moves. When banks shift their settlement rails on-chain, the rest of the financial system follows, and that's why institutional investors from Story 2 are turning bullish again. Before we go into the remaining stories, we're going to take a really quick break. Don't go anywhere, literally 30 seconds, and we'll be back with the rest of today's top news. Let's get into the next story, which is all about analysts clashing over where the market is heading next week. And this is the one where we need to give both sides because the reports contradict each other, and that's actually useful for our listeners. On one side, you've got analysts from Standard Chartered and Matrixport saying they expect next week to be broadly bullish. They argue the market is consolidating in a healthy way. Liquidity is improving. The ETF inflows earlier this week helped stabilize the floor, and macro conditions look slightly more favorable. Standard Chartered's head of digital assets even said today, "We believe Bitcoin will attempt to retest last week's highs before month-end." But the opposing camp, which includes analysts from JP Morgan's digital strategy unit, say the rally looks fragile and that leveraged positions are still too high in parts of the market. Their line was, "Short-term corrections remain likely." So how do we square the two? Easy. Both arguments are true depending on time frame. Short-term, yes, dips are very possible. But medium-term, especially if the new US token classification order lands in December, the market has a solid chance of moving higher. Our view? We slightly edge toward the bullish side, mainly because the fundamentals behind the buying, the institutional behaviors, the regulatory shifts, are stronger than the fundamentals behind the selling. And finally, the sixth story today. The US Office of the Comptroller of the Currency has issued a warning about banks engaging in informal partnerships with crypto firms without going through proper due diligence channels. This one sounds dramatic, but it's not as market dangerous as it sounds. What the OCC is really saying is that some banks are working with crypto companies too casually, without standard risk checks. But the announcement also acknowledged that digital asset adoption within banks is rising, and that clearer oversight is needed to support innovation while ensuring consumer protection. So even here, with a warning, the message is balanced. Not anti-crypto, not pro-crypto. Just do it properly. And that's really the theme of the day. Clarity, structure, maturity. The Wild West era is ending. Not because governments are clamping down, but because the industry is finally being forced to professionalize. For our listeners, the picture is this. Institutions are buying, regulation is clarifying, banks are building, and the market is stabilizing. It doesn't mean next week will be a straight green line, but it does mean the long-term direction of travel looks a lot more predictable. If you enjoyed today's roundup, make sure you follow the show, hit 5 stars on Spotify or Apple, and share the episode if you found it useful. We'll be back tomorrow with another update, and as always, we'll see you at the top.